What happens when you take absolute nobodies right off the street, give them zero traditional financial education, and just hand them $1 million of real money to trade? Well, if that sounds familiar, you're probably thinking of the classic 80s movie Trading Places, where the ultra-rich Duke brothers make a bet about whether a blue blood aristocrat or a street hustler will come out on top. It's the ultimate question, right? Is success written in our genes, or can it literally be taught to anyone? Welcome to This Explainer, where we're going to unpack one of the most fascinating financial and psychological experiments in modern history. And honestly, it's an experiment that proved reality is often way stranger and way more lucrative than fiction. So let's anchor this entire explainer to this really foundational quote by early 20th century American psychologist John B. Watson. He famously claimed that if you gave him a dozen healthy infants, he could take anyone at random and train them to become absolutely any type of specialist. We're talking a doctor, lawyer, artist, or even a thief, completely regardless of their natural talents or the race of their ancestors. This idea perfectly sets the stage for our story today, because right here is the core of the great psychological debate. Is greatness born, or is it made? And that exact debate is literally what sparked a massive financial wager between two brilliant trading partners in Chicago. On one side, representing nature, you've got William Eckhart. He was this brilliant mathematician who firmly believed that extraordinary trading skills were just an innate, unteachable talent, kind of a biological determinist, if you will. But on the other side, representing nurture, you have Richard Dennis. Dennis viewed the markets like a giant game of Monopoly. He believed that trading was based on strict mathematical rules and odds, and therefore it could be taught to absolutely anyone, regardless of their background or their IQ. So, to settle this years-long argument once and for all, they decided to hire and train everyday people. Now, just to prove to you that this wild movie-like narrative actually happened in real life, we're pulling our insights today directly from The Complete TurtleTrader by Michael Covel. This is the definitive chronicle of this whole crazy experiment. Covel actually tracked down the participants, the records, and the rules, completely lifting the veil on a story that Wall Street probably wishes had stayed a secret. Because you see, this story completely blows the roof off the conventional idea that you need elite prestige and fancy insider connections to beat the market. Part 1. The Prince of the Pit. Meet Richard Dennis. You really can't understand this experiment without getting to know the eccentric mastermind bankrolling the whole thing. Richard Dennis was far, far from your typical Wall Street pedigree. He grew up in a working-class Irish Catholic family on the south side of Chicago. While all his peers were walking around in Armani suits trying to look the part of financial titans, Dennis wore cheap polyester pants, hated polished shoes, and would literally stay in bed until the absolute last minute before the market opened. But beneath that super casual exterior was a fiercely independent thinker. He studied British empiricist philosophers, guys like David Hume and John Locke, believing that knowledge comes purely from observation and experience. And he freely used his massive wealth to fund all sorts of causes, donating millions to things like battered women's shelters and the decriminalization of marijuana. He was just a pure anti-establishment rebel who, just so happened to be a total genius at playing the odds. Look, Dennis was so good that he turned a few $100s into hundreds of millions. Naturally, people were practically begging him to manage their money. But check out his trading performance for clients in 1983. In January, he generated a massive 53% return. Incredible, right? But then look at March, down almost 28%. In June, down another 30%. His trading style was incredibly aggressive. He was swinging for massive home runs, which meant taking a lot of little strikeouts along the way. Normal clients simply couldn't stomach the physiological pain of those wild, volatile returns. They panicked and they pulled their money. And this right here was the light bulb moment for Dennis. He realized he needed to trade with people who weren't ruled by emotion. He needed absolute blank slates. Part 2. The classified ad, seeking blank slates. So to find his test subjects, Dennis came up with a genuinely bizarre method. Picture this. It's late 1983. You open up the Wall Street Journal or Barron's, and you see this tiny, incredibly vague classified ad. It says that Richard Dennis, one of the most famous traders in the world, is expanding his operations. He's offering to teach a small group of applicants his proprietary trading concepts. And the kicker? Experience optional. Honestly, would you have believed it? Most people thought it was a total scam, but thousands of people threw their hats in the ring for what was essentially a golden ticket to Willy Wonka's factory. To filter out the herd, he gave applicants this crazy true or false test, and the answers were completely counterintuitive. Play along for a second. True or false? Luck is an ingredient in successful trading. For Dennis, the answer was false. Over the long run, luck means absolute zero.
Okay, true or false? A trader should be willing to let profits turn into losses. To Dennis, this was true. You literally have to risk losing a small profit to ride a massive, life-changing trend. He even had them write an essay naming a risky thing they'd done and why. He didn't want Ivy League business majors who thought they already knew how finance worked. He wanted people who could think purely in terms of mathematical odds and risk.
Part 3. Selecting the turtles. A ragtag roster. Out of thousands of applicants, Dennis and Eckhart picked this wildly diverse group. Dennis actually nicknamed his new students the Turtles because after visiting a turtle farm in Singapore, he declared, "We are going to grow traders just like they grow turtles." And man, the contrast to traditional finance was staggering. On one hand, you have your typical Wall Street elite, Harvard MBAs, folks climbing the Fortune 500 ladder, people relying on insider connections. And on the other hand, you have the Turtles. Richard Dennis hired a Dungeons & Dragons game designer. He hired a master blackjack player who used to smuggle a card-counting computer inside a dingo boot. No joke, he hired a security guard who literally just stood outside his office saying, "Good morning," every day. An accountant. And a guy whose resume simply said, "unemployed." It was a ragtag roster by design. Dennis wanted people who could completely check their egos at the door and become blank slates, ready to absorb an entirely new way of thinking.
Part 4. Rules over intuition. The training. So they bring these guys into a quiet wood-paneled room at the Union League Club in Chicago for 2 weeks, and they teach them this absolutely crucial concept, abstracting money. Because it wasn't just about reading charts, it was about mastering their own psychology. Dennis and Eckhart hammered home that you have to treat money entirely as a variable. It's just a tool to keep score. If you sit there and think about a $50,000 loss as a year's salary or a new house, you will panic and you will break the mathematical rules. You have to effectively detach from the physiological pain of losing. You have to rely purely on mathematical probability and completely abandon human intuition or those gut hunches. Part 5. The climax. The 1978 crash.
Now, you know, following rules sounds super easy on paper, but to really grasp how incredibly difficult it is when the pressure's on, we've got to rewind a bit to November 1, 1978. Out of nowhere, the Carter administration intervenes in the currency markets and hikes interest rates to halt a sinking US dollar. The gold and silver markets collapse almost instantly. And Richard Dennis and William Eckhart, they are caught holding massive long positions, meaning they were betting the price would go up. The market is nosediving and they are staring total bankruptcy right in the face. This is a moment of maximum financial duress. Under that kind of crushing pressure, Eckhart, the brilliant mathematician, he completely freezes. Human emotions just took over. But Richard Dennis? Dennis looks at the collapsing market and ruthlessly reverses his massive position on a dime, shorting silver instantly to ride the downward trend. He didn't let his ego or fear stop him. Eckhart later admitted, "In my book, that was Rich's best trade ever, because he did it under maximum duress." It proved the brutal emotional fortitude required to execute the rules when literally everything is on the line. And that was the exact mental toughness they were demanding of these new turtles. Part 6. Nurture wins the game. So the training ends, the turtles are handed $1 million each, and the result? $3 billion. Yeah, that is a mic drop right there. Long after the experiment ended, William Eckhart, the guy who originally bet that trading couldn't be taught, teamed up with 2 of the former turtles, Jerry Parker and Paul Robar. Today, they manage over $3 billion, and they are still using the exact same foundational philosophies they explored in that wood-paneled room back in 1983. Many of the other turtles went on to make millions of dollars for Dennis and for themselves. The grand wager was settled definitively. Nurture won the game. Success and the rules of greatness absolutely can be taught to a security guard, an accountant, or a game designer. Ultimately, the Turtles experiment proved that the blueprint for success isn't necessarily hidden in our DNA. It's written in objective mathematical rules. But as we wrap up this explainer, I want to leave you with this final provocative thought. The basic rules of the Turtles, they're largely public knowledge today. We know that we have to detach from money and blindly follow the odds, but knowing what to do and actually doing it are 2 very, very different things. So I ask you, if you were handed $1 million tomorrow and the market started to collapse, do you truly have the emotional fortitude to pull the trigger?